Good morning. Global markets have been buffeted by a number of factors over the past few years, including wars in multiple jurisdictions, regulations, tariffs, some closely fought political battles with surprising election results, and volatile inflation. But there's one factor which we think deserves the closest scrutiny, and that is the sharp and large rise in interest rates across the developed world. If you have a look at this chart, which indicates the real yield on the US 10-year bond, you can see that it's increased from minus 1% just a couple of years ago to the current level of plus 2%. That's a 3% change in a fairly short period of time. Now, normally you would expect this kind of tightening to impact equity markets, but as we know globally, particularly in the US, markets have just marched steadily forward. But there are some tentative signs that this tightening is starting to impact the economy. These surprise index charts show quite a sharp fall-off over the recent period of time. Yet, we all know the story of the Magnificent Seven, which continues to power ahead. Those stocks are up over 50% in the last year, where the other 493 stocks on the S&P are only up 10%. And it's also very interesting now to look at the equity risk premium in the US. What we've done here is we've taken the shareholder yield, which is effectively the dividend yield of the market, and we add to that the buyback yield, because lots of companies in the US are buying back shares, and then we subtract the 10-year bond yield. Look how that's changed over the last little while. It's virtually fallen off a cliff. Whereas over the last 20 years, that's averaged about 2.75% Currently, that's gone negative. So the change is a full 300 basis points again over that period. Now, if we think about how global equities are set to perform relative to global bonds over the next while, we can start with the last 20 years, where equities have outperformed bonds by about 7.5%. But equities have re-rated about 2% a year over that period. So if you take that re-rating off, given we are already at high valuations, that reduces from 7.5% to 5.5%. And then, of course, if you look at this chart, equities are at a yield disadvantage relative to their history to the tune of about 3%. So that goes now from 5.5% to 2.5%. And that assumes that equity markets won't derate, they'll maintain their current high rating, and that earnings will grow broadly at the same rate that they have over the last 20 years. So for an extra 2.5%, equities carry a lot of risk relative to fixed income. At the moment, you're getting paid 4.5% per year in dollars just to sit in cash. That's a pretty high hurdle to beat. So what can we do about this? Well, fortunately, there are a couple of things that stand out. The first is that we know the market has strong momentum at the moment, but it is possible to hedge out some of that beta through derivative overlays. This chart shows you the volatility index, which is a good proxy for the price of protecting your portfolio, and it's pretty affordable at the moment. So you can choose to maintain some of your beta, but hedge it out with cheap insurance. Also, outside of that Magnificent Seven, there are still a lot of opportunities. A lot of markets and stocks have been left behind. For example, and there are many of these, this is the UK stock market's rating relative to the MSCI World. Look how that's derated over the past few years. It's currently at a 20-year low relative and a 35% discount to global markets. China is another very interesting hunting ground for us. We obviously are aware that there are many known and unknown risks of investing in China, so you need to control your overall exposure. But there are some really good companies there with pristine balance sheets. And if you adjust their valuations, as we have done so on these charts, for the cash on those balance sheets, some of them have derated 50, 60, 70, even 80% off their highs and are now trading on single-digit multiples with quite interesting growth prospects. Yes, the Chinese economy is currently undergoing a cyclical slowdown, but we don't believe it to be structural, and we think in time these companies can do really, really well. Moving now to South Africa, we all know the result of the recent election and the formation of the Government of National Unity. Look how South Africa's country risk premium has fallen off a cliff. The country risk premium is effectively the additional yield investors demand for investing in South African fixed income over US fixed income. It's dropped from about 4.5% to 3.5% in quite short course. We think that's about fair value. That means that the easy money in SA bonds has probably been made from a country risk perspective, but of course, bond yields are made up of other factors as well. You have your global base rate, which is set by US Treasuries, and you have inflation expectations, and you have the country risk premium. We're of the view that the country risk premium is now fair, but inflation expectations are probably on the high side and can narrow, and US rates also have scope to narrow. So overall, we still think South African bonds are attractive, and we haven't been in a hurry to sell on the back of the recent rally in these assets. Turning now to the performance of the Opportunity Fund, just a quick reminder that our objective is to outperform inflation +5 over the medium to long term. You can see over 3, 5, and since inception, we have managed to just do that. So we've kept up with our inflation plus target, and over those periods as well, we are ahead of the peer group average. Over 1 year, we're a little bit behind, and we've got some catching up to do. The other objective of the fund is not to lose money over any rolling 2-year periods. And since the inception of the fund, we have managed to achieve that, I think, 98% of the time. There were 3 months in the height of the COVID sell down that the fund did go negative, but recovered quite shortly after that. What's worked and what hasn't worked over the past 12 months? Well, it should be no surprise that our holdings in South African bonds, which has been pretty meaningful, and South African banks have benefited the fund given the recent strong rally, as well as our holding in Anglo American, which was subject to a takeover bid from BHP Billiton. What hasn't worked? Well, the 2 largest detractors have been our platinum auto calls. We're quite comfortable with this position because even if the price of the underlying platinum companies don't go up from here, the pricing of those auto calls is such that we'll earn a nice double-digit yield to maturity in that eventuality, with a lot of additional potential upside should those companies recover. Sasol's been a disappointing investment. They haven't quite managed operationally to cut the mustard. There is maybe a small glimmer of hope. Yesterday they came up with an update which the market received quite well. It looks like the new CEO is hopefully getting on top of things. The fund's current positioning has changed a little bit over the course of the last 12 months. The big change has been the deployment of cash into attractively priced South African equities, South African bonds, and South African property, as well as a small increase in global equity exposure in geographies and areas where we're finding a lot of value. But most of that global equity exposure we've also protected with hedges. We do maintain a lot of hedging in the portfolio, and given the high level of yield, I think the fund is currently on a yield of 8-point-something%. We think that gives it a good underpin, and we're hopeful of achieving our inflation plus target in the years to come. So just to summarize, cash rates are very high globally. US bonds are near 20-year highs. We acknowledge that the US market is elevated, but fortunately you can protect that quite cheaply. And outside of the Magnificent Seven and the US, a lot of opportunities exist in those shares and markets that have been left behind. South Africa's country risk premium has moved substantially lower, which is very comforting, but we still see value there and we aren't in a rush to sell. Thank you.